Hey everyone, what the ko? Welcome back. This could change everything. I know this may be tough to hear, but there's a growing awareness that the stock market isn't necessarily climbing. It's the US dollar that's weakening, and when you dig into the data, it's hard to ignore. Despite record market highs when adjusted for inflation and dollar depreciation, real returns are far less impressive, or in fact, they're often negative. International equities have now outpaced the S&P 500 by the widest margin since 1999. And if this trend continues, you could either position yourself to grow substantial wealth or risk falling behind, depending entirely on the decisions you make right now. So in this video, we're going to unpack what's really happening. Is the dollar losing value to the point where assets like stocks and real estate are becoming more expensive? And most importantly, what practical steps can you take to stay ahead financially? But before we dive in, if you find value in transparent, research-driven content like this, please consider hitting the like button and subscribing. It genuinely helps more than you know. This video took nearly a week to produce, and as promised, here's a picture of a corgi for your support. Also, thanks to Policy Genius for sponsoring this video. More on that later. Let's start with the root issue, the declining US dollar. While headlines often overhype this, there's a fundamental truth we can't ignore. Your money will likely be worth significantly less 20 years from now than it is today. Consider this. In 1913, $1 had the purchasing power of nearly $100 today, and had you held onto that dollar without investing, it would now be worth about as much as a single cent. Even though the US dollar remains the world's reserve currency, three primary forces are eroding its value rapidly. 1. Excessive money printing. Think of the economy as a giant pizza. If 10 people split 10 slices, everyone gets a fair share beam. But what happens when the government keeps slicing the same pizza into thinner and thinner pieces? Say 10,000 slices, your portion becomes a mere crumb. That's essentially what's happening with the dollar. With the US national debt now surpassing $37 trillion and growing, investor confidence is eroding, forcing interest rates higher and creating a vicious debt spiral. 2. Political and global instability. Foreign nations are reducing their exposure to US debt. Geopolitical risks, protectionist trade policies, and aggressive tariffs have prompted concerns about the dollar's long-term dominance. Even Deutsche Bank researchers now suggest the global market is undergoing rapid de-dollarization. Recent surveys show 70% of global investors are moving away from the dollar, up from just 31% a year ago. Third flight to alternative assets. Since the US abandoned the gold standard, the dollar has lost more than 85% of its purchasing power. Meanwhile, gold has risen 85 times. And digital assets like Bitcoin are gaining global traction. Even JP Morgan has predicted a structural reset for the dollar, estimating a 10 to 20% decline against major currencies like the euro and yen in the coming years. So, what does this mean for the stock market? For the first time in 2 decades, international equities have outperformed US markets by over 12%. And history shows cyclical reversals are not unusual. The price to earnings PE ratio of the S&P 500 currently sits at elevated levels that typically signal a correction. Vanguard now forecasts lower than average returns for US markets over the next 30 years, while emerging markets show more room for growth. Yet holding cash isn't the solution either. Due to inflation, cash loses purchasing power over time if it isn't invested. So let's explore what you can actually do to protect your financial future. 6 practical strategies to stay ahead. Limit excess cash holdings. Keep your emergency funds, sure, but sitting on cash long-term is almost guaranteed to erode your wealth due to inflation. Diversify. Broadly spread your investments across US stocks, international markets, commodities, real estate, and even digital assets. Diversification mitigates risk. Ignore panic headlines. Stay invested. Data shows that missing just the top 10 market days in 30 years cuts your returns in half. Protect your income stream. A market downturn is often followed by job losses. Secure multiple income sources so you aren't forced to liquidate investments at a loss. Avoid leveraging through debt. Investing with borrowed money amplifies both gains and losses. In uncertain times, this could destroy your portfolio. Don't invest short-term funds. Money you need within 2 to 3 years should remain in low-risk liquid assets, not in volatile markets. Now let's talk about life insurance, and because unexpected events are part of reality. While investing is key, protecting your family financially is just as important.